Good morning. It's Jeffrey Christian of CPM Group. It's 8:30 in the morning on Friday, the 21st of June, here in New York. I want to talk about gold and silver at the end of June, really the next couple weeks. And I want to focus on it because, well, we think that the prices of gold and silver could rise over the next week or so, and I'll tell you why in a second, and then fall back in July. And I think that, as is often the case in these sorts of situations, if you see gold get up to 2,400 or 2,450, and silver gets over $32, $33, you'll hear all these people talking about how gold's going to 10,000 and silver's going to 1,000. And any investors who are naive enough to listen to this ad nauseum, often repeated clarion call that, the dollar's collapsing, et cetera, they'll lose money again, or they'll lose an opportunity to take some profits and reposition at lower prices a few weeks later. And I'll talk about that at the end of the presentation, going back to the period of the record gold silver price. So here's the July COMEX futures open interest. Now on May 28th, there were 733 million ounces of open interest in the July contract, right? About 63 million ounces in registered stocks, about 240 million ounces in eligible stocks. So you had a big open interest in the July contract. And we had pointed out to our clients, and maybe in some of these videos, that the potential was there that as those positions were rolled forward into the September and December futures contracts, there could be some upward pressure on prices. As of the 19th of June, that open interest was down to 380 million ounces. 353 million ounces had been rolled forward, and you had an enormous amount of open interest in the September contract. And then as of yesterday, it was down to 352. So you had 381 million ounces rolled into September. And September has a very large open interest. So the same sort of position will repeat itself in August. And we have spoken many times about how sometimes, not always, usually not, but sometimes these rolls of the futures contracts from nearby active to the next nearby active can have the effect of prices rising. And I'll go through that historic silver price because that's exactly what happened. And a lot of people lost a lot of money or forwent a tremendous profit opportunity because they thought this was the beginning of $50 silver going to $100 silver, et cetera, et cetera, et cetera. So here's silver prices. On the left, you have since January. Prices were flat, where they were trading in a range of 22 to 24. Over the first 2 months, they started rising in March. They rose further in April. They rose further in May, in the first half of May. And in the second half of May, they were kind of plateauing. They've come down since that time. They got down to about 28 something, which had been our target on May 28th when we said, hey, we think the price could come off. And they're starting to rise again. They're about $30.55 as I speak for the July contract. Over on the right-hand side, you see a longer-term chart just to show you the fact that, like on a quarterly average basis, we're pretty much at record highs. And there. Now, our view is that over the next week, the first delivery date of the July contract is the last day of June, last trading day of June, which is next Friday. So we're of the view that over the next 5 trading days, you will see a lot of that 352 million ounces roll into September and December contracts. And that could have the effect of pushing the silver price higher. It could go to $33, $34, even $35 an ounce before coming back off once the roll is behind us. And that's important. Now, the rule doesn't have to, if you are short a July contract, you can deliver into it physical metal, warrants on the exchange. You can buy it back, or you can buy it back and then sell a similar contract forward and simply roll your position forward. And the vast majority of the open interest rolls forward. And that's because these are hedges of long physical positions that banks and trading companies have, where they've leased the metal out to miners, refiners, smelters, fabricators, various types of institutional investment companies that will borrow silver. So the banks and bullion houses and trading companies have long physical positions, which we've explained ad nauseum, and which certain promoters refuse to believe, even though they have the same position on their coin shop books. And the banks and bullion houses and trading companies hedge that long physical position with the futures. So the futures position is not that they're planning to sell into the futures. That's their hedge of their long physical position, and they roll it forward all the time. And usually they roll it forward in the period prior to that first delivery, because they're not planning to deliver. Those are financial hedges against their physical long positions. So they roll it forward. And usually they do that in a period prior to the first delivery day. But sometimes, and increasingly in the last year or so, we've seen some of those short positions hold on into the delivery month. Why that's happening, there are a couple reasons. I won't go into some of the mechanical ones having to do with the cost of money and the value of money and the time value of money. That's the major thing. But also, these guys know that there are any number of promoters and true believers out there who will get spooked and bid the price higher. And, as I've also explained ad nauseum, banks and trading companies make more money on their gold and silver positions at higher prices rather than lower prices. They're hedged, so they don't make money if the price rises or falls. But they're leasing metal at sometimes 3, 4, 5%, sometimes higher, sometimes lower. And 3% of $30 is, well, it's 50% higher than 3% of $20. So the banks that all these stooges, for want of a better word, rail against, saying they're shorting the market and trying to drive the price down and suppress the price. The banks have an economic interest in higher prices. And if you try to sue them for long-term suppression of prices, you'll lose the case, because you're saying to the court, honestly, Your Honor, these people are acting in their own worst interest. They have an economic interest in higher prices, not in lower prices. You got no motive. You can find spoofing where somebody trades on a minute or a 5-minute basis, but you can't find long-term suppression because it doesn't exist and because it's in the worst interest of those trading companies. All of that said, the snake oil salesman will continue to make this point, and they'll say that I'm a lying stooge of the banks, because basically they don't know what they're talking about. Getting back to the market, we would not be surprised to see the price spike higher. We wouldn't be surprised to see the price get to $32, $32.50, $33 over the next week or so. Then our expectation is that the price will come back down. Will it go to $15? No. Will it go to $22? Probably not. Might it go to $29? Yes. Might it go to $28? Possibly. Over the course of July and August, before rising further. That's the situation with the silver price. Our outlook for the silver price predicated primarily on that roll of the July COMEX open interest. Gold also has been trading in this range. You can see gold $2,000 to $2,100 in January, February, rose in March, rose in April, And actually, since April, it's been trading in a range of $2,300 to $2,450. Our view is that the gold price might rise. It could get to $2,400. That's only about $10 or $20 above where we are today. Over the next week or so, we wouldn't be surprised to see the gold price spike up. It's been very volatile in this range. It's a $1,500 range. Or, no, it's not. It's a $150 range. It's a $150 range. That's a very volatile range for the last 2 or 3 months. We wouldn't be surprised to see it get to $2,400 or even $2,450 over the next week or two. And then it comes down and probably stays within this range of $2,300, $2,450 over the course of July and August. And then once we get into September, we wouldn't be surprised to see higher gold and silver prices. Now, some people are confounded because the dollar's actually been rising. And how can gold prices rise when the dollar rises? And as we've explained ad nauseum in these videos, that's not uncommon. In fact, it's relatively common that when you have times economically, politically, and financially, as we have now, you will see investors around the world try to reduce their risk and their counterparty risk. And they do that by buying U.S. dollars, U.S. treasuries, gold, and to a lesser extent, silver. So it's not at all uncommon to see gold and the dollar rising at the same time, because when people really are worried about risk, they will move to relatively less risky assets, and those are dollars, treasuries, and gold. So it's not unusual to see that. And you can see that the dollar has risen, and it's been rising really since 2021. On the right-hand side, there's a longer-term thing going back to 1970, 71, when the dollar was free to float. And you can see it spiked very high in the period 1978 to 1983. And then it came down. And it is not as high as it was when it was fixed at $35 an ounce, and all of the other currencies were fixed against the dollar. But it's also a lot higher than it's been most of the time since 1978. Interest rates. People keep complaining about high interest rates, and they're killing people. And they are suffering. They're suffering because they lived through an extended period of time from 2008 until 2019 when interest rates were very low. The Fed funds rate was 0 to 0.25%. These are 10-year Treasury notes. They were, trading between 0.5% and 2%. And we had this extended period of time of historically cheap money. And people became addicted to that cheap money, and they were buying and they were borrowing to buy more. And corporations were borrowing to buy more and to expand. And governments were borrowing to keep the economies going after the Great Recession and global financial crisis. And that all started to change 5 years ago. And interest rates have gone from, in the case of 10 years, 0.5% up to about 4 to 5%. And people are complaining about these high interest rates, but they don't put it in a historical perspective, and they don't put it into a spreadsheet that says, hey, let's talk about a business plan or something, and let's talk about the cost of money as one of the inputs into how we live, if we're a consumer, or how we operate our company, or how we operate our government. Okay? And then they get confused because the economy in the United States, at least, is still relatively strong, even though interest rates are 10 times what they were 5 years ago. And again, if you studied in high school or college, you would understand that even at 4.5%, 5%, interest rates, 10-year rates, are at their lowest level. They're lower than they were from any time from like 1968, 69 until 2008 when the global financial crisis hit. And we went into that period of very low interest rates. So you've got to put that 5% interest rate into a context not only of history, but a context of the cost of money as an input into how you live and how your company operates and how your government operates. Yes, 5% is a lot more painful than 0.5%, but it's actually cheap money still compared to that previous period. Now, we've talked about this before, and we've talked about the idea that we've gone through two periods of interest rates in modern times. One was the post-1971 period of interest rates. Then we had this period of zero interest rate policies for all intents and purposes from 2008, 2009 into 2019. And now we're moving into a new period. It's not that we're going back to the way things were in the 60s and 70s and 80s and 90s and aughties. Sorry about that. It's something completely different. We don't know where we're going, and that makes it all the more interesting. Now, I want to spend a little bit of time talking about the silver market events in April and May 2011. At the end of April, we saw silver prices approach $50. They went from $31, $32 an ounce, $35, $36 an ounce, up to $50 over the course of April. And all those snake oil salesmen were saying, this is it, this is the beginning, it's broken above 30, it's broken above 38, it's going to the moon. This is it. The world's not run out of silver. There's no silver to mine, there's no silver in above ground inventories. This is going to be it. It's going to 100 or 200 or 750. CPM Group was saying, no, that's not what's going on. And I'll show you some data in a second. We were looking at the data in the market, and it was radically different. What we saw was the May contract had enormous open interest that was rolling forward into the July contract. And that was pushing the silver price higher. We looked at investment demand. I'll show you some data in a second. It wasn't particularly strong. The physical market wasn't driving the price higher. So we said in April, hey, the price is rising because of the May COMEX futures roll into July. Once that's done, or largely done, by the end of April, the price of silver is likely to come back down. And we wouldn't be surprised to see it at $35, $36 within a week or two of the start of May. We were wrong. It got down to $31, $32, $32, $33. It fell even more sharply. And of course, we were blamed for being part of the conspiracy by the snake oil salesman. Here's what you've got. At the end of March, the price of silver was $37.90. May COMEX open interest was 368 million ounces, relatively low compared to the 733 that we saw May 28th in the July contract, or I think it's more than 800 million ounces in the September contract now. Silver ETFs held about 601 million ounces, and the premia on Eagles and Maple Leafs were 9.3 and 6.5%. Respectively. Over the course of April, the price went from $38 to $49, almost $50. That was a record intraday high. Maybe we might have gone higher than that in January of 1980. The price rose 28%. And of course, all the snake oil salesmen, this is it. So, $48, once it breaks over 50, it's going to 100. May COMEX open interest fell from 368 million ounces to 8 million ounces. That rolled forward. It rolled forward into the July contract. Silver ETFs actually rose about 2 million ounces. Some people were watching the silver price rise and say, I want to jump in. Coin investors who are longer-term people because of the premia, coin premia actually fell as the price rose. That's not a function of the higher price and the same margin. What it is a function of investors saying, I was a buyer at $32, I'm not a buyer at $48. So coin investors were not racing into the market buying. ETF investors were buying a marginal amount of metal down, something like 0.3, 0.4% addition to their inventories. Yeah, it's over that, 2%. And coin investors weren't buying. 6th of May, 5 trading days later, the price is $35 an ounce. May open interest had fallen further to 3 million ounces. And silver ETF holders had dumped, they had dumped 25 million ounces. Buy high, sell low. It's good. A little bit too late, but it follows a good saying. Now, what we were saying to our clients, again, looking at this, was, okay, if you want to hold on to your silver, buy puts. And if you really want to be smart, buy puts and pay for them with a call spread. Because the calls, well, I won't go into the details. Or sell your silver and look to repurchase it at a lower price, a significantly lower price. We were thinking $35 and got to $35 within a week. You can pick up $15 profits. Sell at $50, buy back a week later at $35. You've just made $15 an ounce. So insofar as some of our clients listened to us, they made out like bandits. Insofar as some didn't, they said, well, you know, I bought at a lower price, I'm still okay. Because it's going to $100. Some soothsayer on the internet told me that. This is the role of the short positions over April 2011. And this is the ETF holdings. Again, a little bit of buying, but then when the price fell, they said, oh, gee, I guess I should have sold it when the price was over $40 last week. 3 little principles. Every man has a right to his opinion. No man has a right to be wrong in his facts. There's a lot of erroneous, quote, facts touted around the internet about silver. Don't believe them. Second one from Eric Hoffer is, for a true believer to rely on the evidence of the senses and of reason, to rely on what you can see and what you can know, is heresy. But yeah, an act of faith is based on believing something that you can't prove. So if you can prove that it's not true and you give up your belief, you are a heretic to your faith. It's treason. You can't be weaned away from a cause by an appeal to reason or moral sense for a true believer. There are a lot of people who aren't true believers. They look at the world the way I look at it, and they say, there's a lot of stuff that I don't like going on here, but I don't see some grand conspiracy. Or I see a conspiracy of dunces. Great book. You should read it. I see a collection of bad decisions, some of which are made for nefarious reasons, and a lot of them are made based on incompetence. And John Maynard Keynes, somebody said, the problem with the economists is you guys are always changing your opinion. And he said, when the facts change, I change my mind. What do you do? So that's where we are. In summary, our expectation is that the prices of gold and silver might rise significantly next week, and that would be a short-term time to either take profits or to put on some hedges in the expectation that the prices fall back over the course of the first few weeks of July into August. Longer term, we're watching the U.S. election, we're watching developments around the world politically, economically, and financially, and we expect gold and silver prices to go higher later in the year. But in July, the last week of June and the beginning of July, there is this opportunity for those who want to take it. Next week, we're going to have an open forum for clients. Clients want to send in questions ahead of time. We will have a little bit of time. They can also ask questions during the forum. You can sign up by contacting us at info@cpmgroup.com. And then in the middle of July, we'll have our Platinum Group Mellow's Yearbook and briefing. You can always go to our website, read stuff, buy books, and you can send us an email at info@cpmgroup.com. Say, let's talk about how CPM can help me do better with my commodities and precious metals investment. That's all I have for now. Have a good weekend. Take care of yourself. Take care of those around you. And try to do something good for your local community or the world at large, because there's a great deal of need stretched all around the world. Take care.